Hello, I'm Dr. Salvador Espinosa. Thanks for listening. In this brief session, we're going to continue talking about municipal bond markets. In a previous session, we talked about this simple graph. I told you that in the bond market, we have different players. Those players are going to be the issuers of a bond. Then you're going to have some intermediaries. And then you're going to have buyers. This is a very broad representation or depiction of the municipal bond market. Remember that bonds are contracts. I'm going to be telling you this explanation about bonds, but we could be talking about the same thing for a broader concept that is called securities. Now, what we discussed before is that there are going to be different players in this market. Examples of intermediaries are, for example, credit rating agencies. We also have financial analysts. Which, for example, is one of the roles that my students play in the class on financial management that I teach. And on the buyer side, you're going to have, obviously we're going to have multiple players, but in this case, just to exemplify and to focus on this presentation, we're going to be talking about a particular kind of buyer that is a portfolio manager. Now, for the purposes of this video, I want you to think about yourself as a portfolio manager. So you will be playing that role on this session. As a portfolio manager, you represent the interest of investors that are going to be giving you their money and they're going to be expecting a return. It's like when you go to the bank and you entrust your money to them, then you should expect to go back a year from now and get that money plus a certain interest. So portfolio managers receive money and they invest it in different instruments. One of those instruments is going to be a bond. So you're going to have different instruments, you're going to make different combinations. That's why it's called a portfolio. And in that combination, you are trying to maximize or to get the highest return for the people that are giving you their money. That being said, when you are in your desk in front of your computer as a portfolio manager, you are going to invest in different instruments. But you want to have some information about those instruments or those bonds before you actually go and buy them. So you're going to need some information. That information comes from different people, financial analysts, credit rating agencies, etc. When you have that information, and for the purposes of this explanation, I want you to think about a particular bond. Let us assume that you want to add one bond that is going to be issued by a certain government in the future or in the next few days. Because you are thinking about adding that to your portfolio, then you want to know something about that particular bond. So the information that we're going to be using in this exercise is obviously simplified. That means that we are not going to include all the potential information that a portfolio manager might need. So in this case, we are talking about just a few variables. I want you to think about the following. The issuing entity, let us assume that that's going to be the government that is issuing that bond. So you have a government, a local government, that wants to get money to do something, and then they're going to be selling bonds in the bond market. You know about that, and then you want to consider the bond that is going to be issued by that government. We're going to be calling that the issuing entity. You want to know something about the tax status of that bond. What do I mean by tax status? Well, especially in the US market, you are going to have bonds that are taxable. That means that when that bond generates some revenue, then that revenue is going to be taxable. The returns that are generated at that bond are going to be taxable. But in the case of many governments or municipal bonds, which are bonds that are issued by cities, by counties, by special districts, they're going to be tax-free. That means the money that is the return that that bond is going to generate, you don't need to pay a tax for that. So tax status, you think about taxable or taxed, or you can think about tax-free bonds. At first glance, you might say, well, I would only purchase bonds that are tax-free. But usually, tax-free bonds, they give you a lowest return over time than taxable bonds. So this is when you start making, as a portfolio manager, a decision in terms of what kind of instruments you want to add to your portfolio and which ones are not. Because in this particular case, and obviously going to the extremes, if you have a lot of tax-free instruments in your portfolio, your investor might say, well, you are not generating the return that I'm expecting from you. So this is when you start balancing. And when you start balancing, then you're going to have tax, you're going to have risk, etc. Now, another element will be the expected return. And this is related to what I was telling you about the tax status. The expected return is how much money you expect that particular bond to generate over time. So when you buy bonds, those bonds basically are promises of payment. The issuing entity will be telling you, if you give me money right now by purchasing that bond, I have a legal document or a promise of payment that is telling you, I will be paying your money back, let's say 10 years from now. But in the meantime, I will be giving you a return over time. And that return, you know, we can call it a coupon, or there are many terms that we're going to be learning. But right now, before going to the details, I want you to think about the return that you expect that bond to generate over time. And that's going to be the expected return. When I was telling you that you need to balance certain different things as a portfolio manager, well, there's another aspect that is very important, which is your risk tolerance. Some of you might be risk averse, which is, you know, I have a portfolio, I know that I'm going to get a return that is less than others, but I don't want to, you know, take a risky decision, so I'm risk averse, so I prefer to go with tax-free instruments that, you know, they give a smaller expected return compared to others, but I'm okay with that, and I think that my investor is going to be okay. Now, some of you might be more tolerant to risk, and then you say, well, I am more willing to buy bonds that are issued by a government that I know that they don't have a strong financial position. Because they don't have a strong financial position, the risk of default, meaning that they wouldn't be able to pay you back in the future, is higher. But when those kind of issuing entities go to the bond market, they tend to pay a higher return compared to others. So then it is up to the portfolio manager to make those decisions and try to balance taxes, the expected return of the bond, and the risk involved in investing in that particular bond. So that will be our measure of risk tolerance. Now, we're going to start talking now about some variables or some factors that reflect something about the features of the legal framework in the issuing entity. Why? Because if you are, for example, based in the US, you are bound by US laws when you invest in bonds. But if you happen to invest in bonds that are issued in another country, for example, Mexico, then Mexico may have rules that are different than in the US. So you need to take into account the regulatory framework not only of your country, but also the regulatory framework or the country where you are investing. Now, there are different features in here. You know, the list could be very long because usually the legal aspect is something that requires another intermediary, which is going to be a legal counselor. Right now, in this simplified scenario, we're just going to be talking about a few. These features, the ones that I'm going to mention, at least two of them, come from guidelines that are published by an international organization called IOSCO. IOSCO is the acronym for the International Organization of Securities Commissions. If you want to find out more about this, you can go to their website, iosco.org, and you're going to find a lot of information. From IOSCO, I was particularly interested in disclosure guidelines. Disclosure guidelines tell us something about recommendations. Recommendations about what issuing entities or governments where a certain bond market exists need to include in their regulatory frameworks so that they can provide buyers like you with information that you need to make a good decision about the bonds that you are going to buy. So those guidelines, they have several guidelines, but we are interested in a feature that I'm going to be calling timeliness. That is the timely disclosure of data. So as a portfolio manager, I want you to think about this. You are thinking about buying a bond. You want to have some information in advance about that particular bond, but also about the entity that is issuing that bond. You want to know something about their financial condition. You want to know something about the taxes, if it's a local government. You want to know if they're going to be generating enough taxes in the future so that they can, pay you back, etc. And you want to have this information on a timely basis. But then what does that timely basis mean? What if the government tells you, I am going to issue that report with the information that needs to be disclosed once a year? So that might not be enough for you. Some investors might consider timeliness as something that is, as soon as relevant information about the bond exists, or once a week, or quarterly, or semi-annually, etc. So this is just telling you how often you want that information about a particular bond to be available. Something else that is extremely important is to have reliable information. So the second property that is included in IOSCO guidelines is reliability. You want the information that is disclosed to be reliable, but there are different ideas about what reliable means. So you can start thinking, how do I know if the numbers that are showing me are accurate? What are the sources of information that the issuer of a bond is giving me or is using to prepare the information that I'm analyzing? If that information is not reliable, you might be buying a bond that you think it's a safe investment, but it's actually not. So the probability of default in the future is higher than what you think is going to be. That's one of the reasons organizations that present these guidelines suggest to countries to have specific regulations that assure that the information that is disclosed is reliable. Now, the other factor, the final factor that we're going to consider for this exercise is something that I call convergence. And I put this in a different color because I am particularly interested in this measure. There's a concept that I'm developing that is called regulatory harmonization. So when you have two countries or two governments in different countries that are issuing bonds, they're bound by legal frameworks that may be different. So harmonization is telling us to what extent can we create legal frameworks that will allow an investor like you, for example, if you're based in the US, to consider the purchase of an instrument or a bond on a different country, such as Mexico. When you have that the laws converge or that the laws are harmonic, then you might be more willing to consider that other country in your investment decisions. So there are different ways to measure that term. And there are different ways to label that term. I am going to be calling it convergence. So what I'm trying to do with this is, if I provide you with different scenarios that are telling you something about entity, the entity that is issuing the bond, the tax status of the bond, the expected return of a bond, risk tolerance, timeliness, reliability, and convergence. If I give you scenarios that combine these factors, I would be asking you a question after you read those scenarios. Would you consider buying a particular bond and add it to your investment portfolio. This explanation will allow you to understand the basics of what I'm trying to do. This will give you some very basic background about a particular aspect of municipal bond markets in which I'm interested. So once we're done with this explanation, I will be providing you with some information about those scenarios, and I want you to play the role of a portfolio manager. And I want you to think as a portfolio manager, meaning that you are not investing your own money. Someone is entrusting you with money, for example, the retirement money, so that you can allocate it in different bonds. You are going to be creating a portfolio. So what are the factors that are important to you? There are many things that usually that bond analysts or portfolio managers take into account. But in this case, we're going to be focusing on these ones only. Thanks for listening. In a subsequent session, I will be explaining you the specifics about what we are trying to accomplish with something like this. Thank you.